Hi, and welcome to another episode of YourStake, Your Story. We're a video series covering best practices and values-based investing. Today, I'm really excited to have Paula Glick on with me. Paula is from Honeytree. Paula actually co-founded Honeytree in 2018 and has an extensive background in investing, including roles as responsible investing, including roles at Sustainalytics and MSCI. Paula brings a deep knowledge of ESG data, research, and analytics to Honeytree's investment process. Paula, really glad to have you on.
Thanks a lot, Dave. Thanks for having me.
Of course. Do you want to kick things off by telling me a little bit about yourself, your journey to starting Honeytree, and why you started it?
Sure. So I mean, as you mentioned, we started Honeytree in 2018. Prior to that, I spent my first years in my career in the investment industry, moving around a little bit. I gained some, knowledge both on the buy side and the sell side, working in operations, portfolio management, trading. Um, so many different aspects, both on the investment management side as well as on the brokerage side. So I saw different cultures, different approaches to investing. But in the early 2000s, I met Michael Janci, who's the former CEO of
Yeah.
Sustainalytics, that was recently purchased throughout by Morningstar. And we started talking about responsible investing. And it was an area that I just thought, wow, you could take the whole investment world and add in a whole new lens, a whole new way of considering investment decision making that actually aligned with my personal values.
Hmm.
So I got kind of excited about this idea of the ESG space. And in 2004, I was hired by Sustainalytics to help them build out their business. And I had this amazing opportunity to work with pension plans, foundations, endowments, investment advisors, asset managers on, educating them on ESG and ultimately how to use it, how to
Mm-hmm.
implement it, how to integrate it into their different processes. And I was there for 9 years, but then I moved to MSCI, which was further along. And they're for most folks know they're a leading provider of indexes and portfolio risk management. So they had a very strong focus on ESG through some acquisitions.
Yep.
And eventually I was invited to move over there. And that was an exciting opportunity because I could expand my own personal ESG interests beyond the research side, also to incorporate it into risk management, index creation. Um, and so that helped me, obviously build some knowledge, some expertise in the ESG space. But I always knew I wanted to get back into investment management.
Mm-hmm.
And I saw throughout that time, I was scratching my head around certain issues that I saw, and there was always the conversation around risk and return and the benefits of ESG, and then the values-based side of it.
Mm-hmm.
But it was also how people were incorporating ESG, the whole usage of ratings, the stock picking process, how it was actually being integrated. And we always talked so much about in ESG about the importance of ESG integration, but what did it really mean?
Mm-hmm.
Um, and I saw some major issues. I saw that ESG teams were often very siloed. They weren't actually part of the
Yeah.
investment decision-making process. They were a reactive team that either did like annual analysis of their portfolio across different considerations, whether it was like a deep look at climate change issues or tobacco or whatever it was. These were reactive processes or analyses, and or they spent their time doing proxy voting and engagement, but it was very separate. And
Yeah.
there are some circumstances where portfolio managers were actually looking at ESG issues, but maybe it wasn't as systematic. So the way to be able to build it in a systematic way was to look at a rating, which is what most people did. They either employed the ESG research companies to do kind of eligibility universes for them,
Mm-hmm.
And then they could just, as a secondary thought, go, yep, it passes, okay. And still today, we're dealing with
Yeah.
a lot of the same issues. The idea of ESG integration is not really there. And it's also about intentionality. And a lot of portfolio managers don't necessarily really care about it. It's a marketing opportunity. It's an opportunity to grow their business.
Yeah.
It's maybe a set of products, but it's not holistic. So I think Liz and I met, and she was trained in quantum mental strategies. And um, the one thing that was missing for her was the intentional approach to incorporate ESG into the companies she was investing in. She had some clients who had come in and said, why do you own this company? Or why do you own that company? She was like, yeah, I agree. And it was that the idea, the interconnection between ESG factors and profitability, financial performance also was intriguing for her. So she was starting to look at this, and then we were put together or suggested to meet and talk about the issues because she was very interested in it. And somebody at the time from RBC's ETF world introduced us. So that's sort of how we kicked off our relationship. And then, we started to talk about, how do we build out an investment process that integrates ESG. She showed me what she grew up learning to do. And it lent very well to being able to actually implement environmental, social, and governance factors alongside financial
Mm-hmm.
in a so-called spreadsheet, a dashboard where we could look at all of these things on equal footing, and not as a secondary process, but actually intentionally, putting risk management alongside governance management, or governance risk alongside financial risk.
Mm-hmm.
So we could look at things and bucket things accordingly.
Mm-hmm.
And we looked at, the opportunity to build out a global equity product. That was the first product we wanted to build out, and we thought it might be easier to find more companies based on our restricted list of criteria that we wanted to see. We wanted our process to be very robust around ESG and holistic, not thematic in nature, which is what we were seeing a lot of at the time
Mm-hmm.
being created, or best of sector, which was, again, ends up mirroring a lot of what the index looked like. And we weren't into passive. We wanted to do something very concentrated, almost like a high conviction approach to investing, which made a lot of sense from if you're going to go active, you've got to, kind of create that concentrated active approach for alpha, right?
Mm-hmm.
Because otherwise, yeah, like so many investments out there, the larger the number of holdings, the more index looking at it behaves more like the
Yeah.
index. So we were looking to really differentiate from that perspective. And we looked at potentially building out that product and then shopping it around to other managers that might have a gap. But then we actually reflected on the fact that one thing that's always bothered me is asset managers who, as I mentioned earlier, build out an ESG or 2 or 3 products over here, but the rest of their
Yeah.
offerings, there's a disconnect, right? There's a
Yeah.
disconnect in the messaging, and that impacts the intentionality of the manager. So we thought, well, if we start our own firm, we could have a consistent, disciplined approach to investing across all of our strategies that works, that's similar, and that all incorporates environmental, social, and
Yeah.
governance. And the other thing was that we realized there's very few female-founded ESG asset managers in the world. There's very few female-founded asset managers long only space, but even fewer that are actually doing ESG. I think we're the only ones
Yeah.
in Canada, and I think we're one
Yeah.
of 5 ESG, one of 5 female-founded asset managers in this country. So
Wow.
we kind of have to go out on a limb and try this. So that's sort of in essence how Honeytree came about.
Very cool.
It's an opportunity to build something new and innovative, I think, in the industry.
So I'd love to ask, what is the in the most concise terms, what is the intention behind the intentionality that you all have? What are you hoping to achieve?
Well, we want to make a net positive impact. And I say
Yeah.
net positive because all companies do good things and bad things. I mean,
Yep.
there's no such thing as the perfect company. And we totally recognize that. But what we're looking for is companies that are responsibly growing and where we can safely say that, in the thematic world of environmental, impact companies, you could say, the company that's building the wind turbines or the company that's building solar energy, well, they're automatically an impact company.
Yeah.
But you have to look at their social, their impact, negative or positive, around how they're governed, the impacts they're making on the community where they operate, and their employee base,
Yep.
how they treat their clients, all of those things that drive long-term growth, because those things they can detract
Yeah.
from performance, from reputation, from operational efficiencies. And so we're looking at a much broader viewpoint on impact. And so again, our companies aren't thematic in nature. They could be making, clothing or shoes, or they could be a consumer staples company,
Mhm.
or a tech company. It doesn't have to be an obvious, but what we're trying to find are companies that are well stakeholder governed, that understand that the impacts they're making on all their stakeholders is actually what's driving their bottom line. It's not just
Yeah.
about a product or a service. Um, and yeah, and that's the sort of um, circular viewpoint of impact that's very positive on ultimately the growth and
Yeah.
long-term performance of companies. And it makes you, feel good as an
Yeah.
investor, to know that your companies are doing things to mitigate climate change, to that they care about their employees, and they intentionally make efforts to build inclusivity, proper programs and initiatives in that regard, to grow their base of potential candidates for jobs.
Yeah.
Uh, yeah,
Can you
greater
share an
efficiency in their
example?
business.
Go for it.
Yeah, sorry. I was just, on the environmental side, we look at other, environmental considerations that obviously are going to lend to greater efficiencies in business operations, that are going to save the company money. They're
Mhm.
also at the same time good for the environment, right? And are gonna, they're driving force toward mitigating climate change.
Yeah. Can you share an example or story of a company that fits that thesis, and maybe also an example or story of a company that maybe is thematic and one might expect might fit that thesis, but you actually there was something that you uncovered where it doesn't.
Well, an obvious negative one, or one that we just never considered including, was Tesla. It
Yeah.
was the darling for so many ESG funds out there, and was considered, 100% impact, and it was, wonderful in that regard. But we had always sort of looked at, the management and some of the issues that we saw around some of the social side of the equation, and the governance. And so we just never, it was never a company that would make it into our criteria. But a company that is not obvious to many folks, because we are, and I can talk a little bit about our process, but we don't invest in oil and gas companies
Mhm.
or coal companies, for both financial reasons as well as for environmental reasons.
Mhm.
Um, but again, all of our companies, and most of our companies, in one way or another, are utilizing carbon and these forms of energy to create their products or services, run their operations. So
Yep.
we're looking for companies that are slowly moving away from that, but let's be realistic that, it's embedded in many respects through supply chains. And so we're very conscious of that. But one of the companies that we own, for instance, is Cummins,
Mhm.
which is, builds diesel engines, but to greater efficiency. But at the same time, they also, have a huge part of their business focused on electric engines, as well as green hydrogen.
Interesting.
So they're transitioning their business in some ways and trying to move along that climate trajectory, anticipating growth in those spaces. But it's also a great win-win story. You know, everything they do is really driven toward improvement, toward systemic change, because they're really an important provider to the
Yeah,
market.
very cool. And you mentioned that you'd be happy to walk through the process. I'd love to hear um, what differentiates your process from other ESG management. You definitely talked about the intentionality of the whole firm, and I totally agree that there's a big difference between intentionality in the prospectus of a fund versus intentionality of an entire firm, and you see a lot of differences in terms of what the construction engagement looks like from that perspective. But yeah, if you could talk about what's different about your approach, I think that'd be really helpful for the audience that we have.
Sure. Well, we are, as I mentioned before, a quantum mental process. So we start and so it's a two-phase process. We start with a large index, depending on the strategy, whether it's global or US, and we apply 25 qualification criteria to start. And those are a combination of functional, like availability, market cap. We look at some financial criteria, and then we look at some ESG. We have some negative ESG screens. One of the areas that we look at is diversity. So at the board level, right off the get-go, we're expecting diversity beyond gender. It's not just gender, it's racial. We're looking for other indicators of diversity. And it's just one of the considerations for us is about the governance of a company. If you can't figure out how to get a diverse enough uh, um, sample of good board members, then you haven't really, been able to. It doesn't demonstrate to us good governance,
Yeah,
and so we expect 33% board diversity from the get-go. We also look at Glassdoor rating, which is another interesting.
yeah,
It's not the be-all and end-all in its own right, but because we skew large cap, a lot of these companies have a good sample size of past employees or existing employees that are rating companies. And so we look at these ratings as another indicator of employee health, good governance. If the rating is so low and everybody's just tanking the company, then it's, we can easily just make that cut. Again,
yeah,
because we're high conviction, we're very concentrated, we can afford to be a little picky around these sort of considerations. But that's our initial, we cut away at the index, the large index, by using these 25 qualification criteria. And then we get down to a much more manageable consideration set. We're a small firm, and we learned this through my co-founder's old shop where she was trained in quantum investing. And it had a very similar process from that perspective. They just didn't consider ESG the way we do. They didn't consider it at all. But we've definitely inherited a lot of the same thinking around structure and process. The second phase is really with that manageable consideration set. We do the deep dive, and there we use about 45 different criteria, where we're able to really delve into the different companies, everything from, looking at science-based targets to really
mhm,
understanding social initiatives. We look at, paternity leave and maternity leave and parental, things that aren't traditional, just in order to understand how inclusive the company is. Are they understanding the value of taking into account how maternity leave and paternity leave impact on culture? Because a lot of men, in the investment industry don't take leave even when it's given to them. And
mhm.
then the women do, and there's a lot of stigma around these issues. There's pressure. Women often, don't come back, or they, or they're stigmatized for taking too much time. There's a lot of pressures, whereas when men jump in, and some companies that we've owned and that we do own actually have been very forthright about demanding that their men take leave.
Interesting.
Yeah, and it just helps to level the playing field in terms of, and it's also great, from a bonding perspective. There's all the social impacts and the reverberating effects. Same with, when you build on inclusivity in the workplace and in the areas where you operate, those neighborhoods, like everything, it's all very, it all impacts each other. So the deep dive is obviously a way to better understand our companies from a financial perspective, debt capacity, all sorts of interesting aspects, competitiveness and leadership, and
Hmm.
where they operate around the world, and where growth is potential for these companies. And so by that, we're able to then pick our final selection. So in our global equity, we only own 20 positions. Um, in the US equity ETF that we just launched in the fall, we have 25 positions, but that's
Hmm.
because there's a concentration rule, for ETFs, and that's the
Hmm.
minimum size um, that you can actually make an ETF with in the US. So that was an
Yeah.
interesting. So we had to expand, um, our criteria, our holdings for the ETF.
Do you want to just share the ticker of the ETF?
Bees, BEEZ.
Very cool.
Yeah, it connects to our honey tree theme, which is all about bees. It's all about the endangered bees, the importance of bees, and their disciplined work ethic. Um, yeah,
I
it's
love that.
interesting.
One story that you definitely didn't bargain for, but if I were to get a tattoo, and there's a good chance, it would be of a bee. So
Oh,
I'm with you
really?
on that. Yeah.
That's
Lots of
so
reasons,
cool.
but yeah, I'm a big fan of that.
Why?
Oh, we need another half hour. What I'd love to end with is, where do you see the future of ESG going in the next 5 years, with the last minute or two that we have, either for your firm or for the field in general?
I mean, we know, the International Sustainability Board is mainstreaming all these criteria. Companies are already, I mean, in the 5 years that Honeytree's been around, we've seen so much growth in terms of disclosure and transparency around environmental and social issues. It's only going to continue, but I think it'll become so mainstream. It'll be just like the financials, in that, the disclosure of all of
Yeah,
that data that can be utilized, by folks, to incorporate as additional insight into, companies, risk. It's a risk management, it's an opportunities assessment, and I mean, I think that that's where it's going. It's just going to be mainstream, and part of overall consideration. I mean, you need to know as much as you can about companies in order to make good decisions. And that these are essential inputs, I think. I mean, some more than others, but the
hmm,
stuff that the ISSB is looking to regulate, which is part of IFRS, which does the financial considerations, is all just necessary good data to have.
amazing. Hey, well, thank you so much for joining, Paula, and I hope you have a wonderful weekend. Of
Thanks, you too. Yeah, thanks for having me.
course.